Local government agencies cannot pay employees more than 110% of the governor's salary without a waiver from the state. Let's take a look at the administration of the governor's salary cap in the compensation of employees in local government agencies. State law limits the amount of compensation political subdivisions may pay employees. Under current law, statutory and Home Rule Charter city employees may be paid 110% of the governor's salary. Adjustments to this salary cap are made annually based on the Consumer Price Index. Effective January 1, 2017, the compensation limit is $167,978. For reference, the 2016 compensation limit was $165,333, and the 2015 limit was $165,003. This statutory limitation applies to the salary and value of all other forms of compensation. Salary is defined as the hourly, monthly, or annual rate of pay, including any lump sum payments and cost of living adjustments. Employer-provided deferred compensation payments and payroll allocations to purchase any individual annuity contract for an employee are also included as salary. All other direct and indirect forms of compensation that are not specifically excluded must be included in determining employees' total compensation. Payments excluded from compensation include the following: employee benefits that are also provided to the majority of all other full-time employees of the political subdivision, vacation and sick leave allowances, health and dental insurance, disability insurance, term life insurance, pension benefits or like benefits, the cost of which is borne by the employee or which is not subject to tax as income under the Internal Revenue Code, dues paid to organizations that are of a civic, professional, educational, or government nature, reimbursement for actual expenses incurred by the employee, which the governing body determines to be directly related to the performance of job duties, and the relocation expenses paid during the initial year of employment. Agencies may request a waiver from the Commissioner of Minnesota Management and Budget to pay an employee in excess of the 110% governor's salary cap. An agency must show that the position requires special expertise necessitating a higher salary to attract or retain a qualified person. The Commissioner then reviews each waiver request against salary rates for other positions with similar responsibilities in the state and nation. The Commissioner must notify the Legislative Coordinating Commission to receive the Commission's advisory recommendation on the waiver. The waiver is tied to a position versus a specific employee. Thus, once a person leaves a position, any previously awarded waiver remains in effect for that position when hiring a new employee. Once the agency has received a waiver, additional annual increases can be given based on the Consumer Price Index without the request for a new waiver. There are some common concerns in the administration of the governor's salary cap in local government agencies. Let's take a look. The statutory subdivision defining salary excludes payments due to overtime worked. However, the state statute that creates the salary compensation limit does not include overtime in the list of specific exceptions to salary. Most local government agencies reaching the salary cap are exempt employees, who are generally not paid overtime. The common practice is to not consider overtime as compensation in determining the salary limit. Employees sometimes receive a cash allowance for the personal use of a car, an expense allowance, or a housing allowance regardless of actual expenses. Generally, these forms of compensation are considered part of a position's salary. However, reimbursement for actual expenses incurred by the employee, such as mileage reimbursements for travel on official business, should not be included in salary. If an employee receiving a cash allowance for the use of car tracks his or her mileage, the cash allowance may arguably be excluded from the salary cap. Some agencies may allow their management team a higher increased contribution for health insurance than other employees receive. This inclusion of additional agency contributions to insurance is open for interpretation. In general, the benefit does not have to be equal to be excluded because it's common practice for employers to award benefits at different levels based on factors such as longevity or position held. An important note here that the Affordable Care Act has changed this dynamic, and this contribution exclusion might not be necessary in conversation about the salary cap any longer. Since this is a matter of interpretation, agencies are strongly encouraged to work with their attorney regarding what additional compensation, if any, in the way of benefits is appropriate for employees. Upon termination of the employment relationship, unused vacation and sick time may be paid to the employee without being included in the salary limit. An employment contract that allows an employee to cash in accrued vacation or sick time during the employment relationship is compensation that must be included in the salary determination as a lump sum payment. The value of life insurance is specifically excluded from the employee's salary by statute. However, split dollar life insurance policies and other types of life insurance would be considered compensation that must be included in the employee's salary. In split dollar life insurance policies, the agency and the employee share the cost and benefit of the policy. Employer contributions to employees' post-employment health savings account are not likely counted towards the salary cap limit. Such contributions would probably be covered by the exemption for pension benefits or other like benefits, the cost of which is borne by the employee or which is not subject to tax as income under the Internal Revenue Code. Employer contributions to deferred compensation plans should be included as salary. These types of plans in local government agencies generally include 403Bs, 457Bs, or 457F plans. Employee contributions are not considered salary because they would have already been counted as salary received from the employer and therefore should not be counted twice. An agency may contribute to a deferred compensation plan or PERA administered defined contribution plan for a chief administrative officer who elects to be excluded from membership of the PERA General Employee Retirement Plan. The agency may contribute up to the amount that the city manager or employee would receive as an employer contribution if that position were a member of the General Employees Retirement Plan. The governor's salary cap law continues to change. For many years, the state legislature has enacted and amended the law that limits the maximum amount of money a public employee may earn. Numerous amendments and revisions make for a complicated statute. Best practice suggests attention to current law and guidance on any specific salary limit issues.